Central banks are once again cutting interest rates. Almost all advanced economies, except for Japan, Australia, and Norway, have already embarked on an easing cycle. Among the BRICS economies, South Africa joined the easing club this week, and China cut its 7-day repo rate for the second time this year. In the last two global easing cycles, after the global financial crisis and during COVID, we saw an unprecedented convergence of policy interest rates. Zero became the norm for most advanced economies. What about this time? What will be the terminal rates in this easing cycle? What will be their most important determinant? And what does tech war have to do with it? The global financial crisis and COVID were both global shocks. They set off a global recession that left very few countries untouched. This was why we saw convergence in policy interest rates across countries with very different economic characteristics. The situation today is very different. At the risk of overgeneralization, I think countries are more different than they are similar these days, mostly due to their positioning in the global geopolitical fracture and the global tech race. This is not to say that there are no common themes. For example, most major economies are sitting on a lot of debt. Japan is still in a league of its own with a total debt to GDP ratio of 450%, but France and Canada are fast catching up. Not too far behind are South Africa, the US, China, and Italy, with their total debt to GDP ratio all hovering around 270% of GDP. Even the fiscally prudent Germany has now a total debt of 200% of GDP. High debt burden means interest rates have to stay low to keep debt servicing costs under control. Everyone knows that the US government will spend $1.2 trillion on making interest payments on its debt in 2024. But the truth is that most major advanced countries and a handful of middle-income countries like China are in the same boat. Their sustainability requires that their interest rates are no greater than their nominal GDP growth. For countries with heavy debt burden, the interest rates they could afford to pay on their debt will be increasingly determined by how fast they can grow their economies. Here, the differences across countries are increasing. Economic theory said that long-term growth potential is determined by population growth and labor productivity growth. The past 5 years have seen a huge disparity in labor productivity growth across OECD countries. At one extreme, we have Israel and the US, where labor productivity has increased by 43% and 25% respectively. At the other extreme, we have France and Germany, where labor productivity has declined by 18% and 3.5% respectively. For a while, the consensus among economists was that this disparity had to do with differences in policy response to COVID, and that it would mean revert once the pandemic was over. The lockdown was long over, and there have been few signs of mean reversion. At this point, I am inclined to think that not only this disparity is permanent, but that it might increase further. If I'm right, this would imply a growing disparity in the neutral policy rate, the so-called R star, as well as the terminal rate in this easing cycle among countries. If I'm right, the Bolaso-Samuelson effect says that we should expect labor productivity growth to become a major, if not the main driver of currency movements going forward. Mario Draghi, former ECB president and Italian prime minister, released his long-awaited report on the future of European competitiveness last week. In the report, Draghi called for a new industrial strategy for Europe to encourage innovation and boost productivity. Draghi warned that policy procrastination could lead to permanent stagnation or worse. I don't agree with all of Draghi's policy recommendations, but I agree wholeheartedly with his assessment of the new global paradigm. He identified three major drivers of the changing global landscape. 1. Slowing global trade. 2. Fracturing geopolitics. 3. Accelerating technological change. With Europe's trade to GDP ratio over 50%, compared to China at 37% and the US at just 27%, slowing world trade is a bigger headwind for Europe than for China and for the US. Fracturing global geopolitics means Europe can no longer free ride off the US security umbrella and is now forced to divert resources towards defense. Fracturing geopolitics are also forcing Europe to spend more on energy. Then there is the acceleration of technological change. Only 4 of the world's top 50 tech companies are European, and European companies spend less than $300 billion a year than their American counterparts on research and development. A great example of how these forces are reshaping the global competitive landscape is the global auto industry. The automotive sector is Europe's top spender on R&D. The top 3 R&D spenders in Europe are all auto manufacturers. If Europe cannot compete in autos, then Europe has a real problem. And yet, this is exactly what's happening. Year to date, 3 out of the 4 worst performing car company stocks are European. Earlier this month, Volkswagen, the world's largest automaker, announced that it would be laying off 15,000 employees and close down factories in response to stiff competition from Chinese rivals. This will mark the first closure of VW factories in Germany since 1938. A few days before, BMW stocks plunged after the company revised down its profit margin forecast to 6 to 7% from 8 to 10%, also citing weak demand in China. China's overall passenger vehicle sales have been falling, but its sales of electric and hybrid vehicles are actually up due to government policies encouraging rapid green transition. This has helped cheap Chinese EV producers to gain market share in China at the expense of Volkswagen, whose market share in China has slipped to second place behind BYD. Toyota and Honda, in third and fourth places respectively, also lost market shares in China. However, Toyota has seen an increase in market share in the US, where it is the #1 selling brand. Toyota's success in the US also has mostly to do with technology. Toyota is reaping big rewards from backing hybrid vehicles. With the US way behind China in terms of the number of charging stations per electric vehicle, hybrids are gaining popularity with Americans at the expense of full electric vehicles. Toyota's plug-in sales in the US increased by 112% in the second quarter, compared to a year ago. Meanwhile, China has become the world's largest car exporter, with its car exports growing 25% so far this year. The Japanese and the American car manufacturers have been less affected than European car manufacturers by increasing Chinese competition. This is because the 100% tariffs on Chinese cars introduced by the Biden administration that has kept out Chinese competition in the US market. This is a different story in Europe. In 2023, 38% of Chinese car exports went to the EU. Despite the proposed 37% tariff on Chinese cars by the EU, Chinese EVs remain more affordable than comparable European models. Meanwhile, BYD is building a factory in Hungary, which will be exempt from EU tariffs. Looking out 12 to 18 months, Volkswagen is set to lose market share in both China and at home. It can try to grow its market share in the US, but it will be from a low base. Meanwhile, it is facing threats of union strikes and production disruption that will hamper its ability to cut costs and boost competitiveness. The premium brands like BMW and Mercedes will fare better, but not much better. Stellantis does not export much to China, but it is even more vulnerable to Chinese competition at home and in third markets. The future is pretty bleak for the European auto sector. This bodes poorly for the European economy. The auto sector, which accounts for 8% of European Union's GDP, provides jobs for 13 million Europeans. It generates 80 billion euros of trade surplus for the EU and 380 billion euros in terms of tax revenue. Eurozone manufacturing PMI fell to 44.5 in September, the lowest reading so far in 2024. America gave birth to the IT revolution that helped level the playing field between rich and poor countries. America is now giving birth to the AI revolution that it hopes will help cement its hegemony. Technology is power in the brave new world. Regardless of the outcome of the November elections, American foreign policy will continue to focus on ensuring that America maintains its technology leadership. As I argued in a previous video about AI and cloud computing, this is raising both America's R-star and the fair value for the US dollar. China knows that to join the ranks of the rich countries, it will have to break the lock of rich countries on technology. But its challenge has become much greater as the result of its curtailed access to Western technologies. Xi Jinping has decided to double down on winning the tech race. This is a risky bet. Right now, China looks unstoppable in EVs. But this could change if Europe decides to follow the US lead and close its door completely to Chinese cars. Regarding the tech war in advanced semiconductors and AI, China is facing an uphill struggle. It is hard to see China catching up to NVIDIA, TSMC, and ASML in the foreseeable future. On a 12 to 18-month horizon, I'm confident that China's R-star will decline further and that the RMB will weaken as China's short-term problems catches up with it. What about Europe? Draghi says Europe needs to spend 800 billion euros a year to catch up to the US and China. Germany and Netherlands immediately poured cold water on the idea. Europe is so behind in the key technology races that it is not clear that Europe will be able to catch up, even if it were to spend that kind of money. With both the populist right and the populist left on the rise in Europe, political gridlock will make it impossible for Europe to embrace change. Draghi says Europe is staring at a slow death. To me, it seems inevitable. For Europe to stay competitive, it will need a much weaker euro. In this respect, I view a weak euro as the path of least resistance. Thank you for listening.